Hi, everyone. Mark Sorensen. Today is June 6, 2022, and we're going to put out our market commentary after the end of the second quarter 2022. The market continued to be extremely volatile in the second quarter, meaning April through June. We've had a couple of rally attempts in March, back half of May, back half of June. But so far, the volatility continues to unnerve a lot of people. Today, we're going to give you some perspective on recessions, if we're in one, and what typically happens to the market, and why this should be looked at as a time of opportunity and really not a time to panic. But those are words easy to say when you're watching the market on a daily basis. You know, there's an economist by the name of Paul Samuelson that once said, investing should be more like watching paint dry or watching the grass grow. But there are times like this when it gets very volatile and it's not any fun, of course. However, there's been a lot of talk about, what is this time like? Is this like the 1970s when we had stagflation? Meaning high and persistent inflation and higher interest rates as a result of that, but very slow growth for a longer period of time. Paul Samuelson went on to say that even during that time, if you put $100,000 in the market at the beginning of 1973, it would have gone down to $59,000 or down 41% during that period of time. However, in 1994, 20 years later, the 59,000 would have grown back to $936,000 and today be worth about $13.8 million. So the point is, we talk about patience being rewarded. We talk about trying to look 6 months or a year past this and everything will be okay. But history tells us that that is a fact. The other question right now, or the concern in the market, is are we going to go into recession or not? And that is greatly dependent on whether the Fed moves interest rates too high, stymies growth too quickly, and causes the economy to go into a recession. However, there's not been a recession come from such a strong economic position that we were in at the beginning of the year, with 3.6% unemployment, still more employees for the jobs that are available. And so not saying that there won't be a recession, but we do think this is just a slower growth period of time. And we also think there's a reasonable chance, based on charts I'll show you in a minute, that the Fed might quit sooner than we think. There are already some signs that some of the commodities and inflation might be rolling over a bit. Which could cause the Fed to pause. I've said in previous videos that the market makes major moves based on a variance from expectations, not based on expectations being met. And right now, the Fed is so hawkish, and even their commentary is so hawkish, that we expect that the variance from expectation will be when they announce they're going to be more dovish. And that could come as soon as the next meeting. We get the next CPI report on July 13th. That will tell us how, whether inflation has peaked or come down a little bit in June. And then we get the next Fed meeting the last week or so of July as well. We still expect they're going to raise 50 to 75 basis points. The market fully expects that. But even if they just announce that because of the slowing that they're seeing, that they're going to be more data dependent moving forward, the market would take that as an extreme positive. I'm going to go back to Paul Samuelson for a second. He was famously quoted as saying one time that the market has predicted 9 out of the last 5 recessions. In other words, that the market having the turmoil that it's in right now does not necessarily mean we go into a recession. Is it predicting one of the 5 times we did go into recession, or is this going to be one of the other 4 times when the market did not go into recession? We'll see. But what I'm going to talk to you about today is give you a little bit of information about what actually happens during a recession. But first, let me show you some charts about why we think inflation is starting to ebb a little bit, and that will ultimately be proven to be quite positive for the market. I'll share my screen. This is a chart of the energy complex, the S&P 500 energy complex, and you can see what's happened. Already, as you watch TV, you'll see that oil prices have rollen over quite substantially, and you can see just since middle of May or so, we've seen energy peak and start to come down dramatically. The next chart that I'm going to show is lumber. Lumber back in about beginning of March or so was $1,079.80 per thousand board foot. This is a September futures contract on lumber. As you can see, in June it fell all the way to 522, or in other words, down 50%. So more proof that we're seeing some of the commodities roll over, and we think inflation will ebb in time. The next chart I'm going to show here is gold. And the reason I'm showing the gold chart is because it's interesting. I thought gold was an inflation hedge. I thought gold was supposed to rise during inflation. Well, you can see when inflation first hit the scene, and possibly, with the expectation that it might go much higher back in January, February, gold did rise considerably, but now it's come all the way back down. So gold is not even predicting an inflationary environment. The other chart, the last chart I want to show you is a 7 to 10 year U.S. Treasury bond interest rate chart. Keep in mind that bond prices move in an inverse relationship to interest rates. And you can see here that the chart measures the price of the 7 to 10 year U.S. Treasury bond. So when the price is going up, it means the yield is going down. We peaked on the 10-year Treasury about the middle of June at around 3.49%, and already are back to about 2.8 on the 10-year Treasury. Why would interest rates be falling right now with expectations of inflation and the Fed tightening dramatically more? Well, the bond market is probably telling the Fed that enough is enough. The bond market probably predicts the future even better than the stock market does ultimately. So with interest rates back down, the bond market is saying that the economy is slowing. We are seeing a slowing growth to the point where the Fed doesn't have to do a lot more. Now, whether the bond market is right, the bond market is historically more accurate, as I said, than the S&P 500 or the equity market. We will likely get a hike at the end of July, whether it's 50 or the prognosticated 75 basis points. That is already expected by the marketplace. Again, the market doesn't move based on expectations. It moves from a variance of expectations. And so we'll be looking to see if the commentary after that is a little bit more dovish, that the Fed will be more data dependent at that point in time. Next thing I want to show you, I think is very important too, and that is just to understand, should we really fear a recession? Recession is just a reset, if you will. The economy gets a little too strong, so now we got to come back a little bit. But typically, recessions are when the next bull market starts. John Templeton is famous for saying that bull markets start during a time of pessimism. They continue to do well during a time of skepticism. They continue during a period of optimism, and they do not die until there's a period of just absolute euphoria where people can forget that the stock market can ever go down. I have not seen in my 40 years quite as much pessimism as we're seeing right now. Consumer sentiment is at historical lows, and yet consumer spending is still holding up. I can see the difference. Obviously, you feel it too. Consumer sentiment is down based on our political situation, but more than that, the price to fill up your tank with gasoline. the price to buy the basic essentials to go grocery shopping. So that has dampened sentiment. But consumer sentiment is, consumer spending is still holding up pretty well, and we think corporate earnings will likely hold up too. We've already been adjusting, re-rating, if you will. The price earnings ratio on the S&P 500 has gone from about 21% all the way down to about 15.5%. We are actually slightly below historical averages for valuations. And in fact, another reason we think we're at or near the bottom and the market will start to recover in the second half of the year is simply the fact that we've got consumer staple stocks, the toothpaste and toilet paper type of stocks that are now trading at valuations, even though they're only growing at 5% a year in terms of their earnings. They're at equivalent or higher valuations than some of the higher growth stocks that are growing at 20-25% a year. We're already seeing the last couple of days the NASDAQ start to outperform the Dow and the S&P 500, which means people are feeling more confident that growth will return soon. The chart you're looking at now is the last 10 bear markets, this being the 11th since 1950. And I want you to look at what happens the 6 month past the bear market. 45.9%, 52%, 11%, 19, 44, and so on. And you'll notice that the lion's share of the next 1 year move takes place in the first 6 months. In other words, once the market starts to turn, the lion's share of the 1 year gain happens in the first 6 months post the bear market. And so you can't predict when that's going to happen. You just have to look past it, the current volatility. You just have to look 6 months, a year down the road and know that it's going to happen. A similar chart that I want to show you about recessions is this one. I mentioned a minute ago that the market actually starts to recover during the recession. And there's a reason for that. Remember that the stock market is a leading indicator. The market looks past it once you're in it. So this chart's interesting because if you look at the recession beginning and ending dates on the left, and then you look at just the 3 months return of the S&P 500, the broad-based market representing the stock market, broad-based index, the 3 months before the recession ends, the market's up 3.2, 15.2, 8, 23%, 16%, 17.5%, and so on. And then you look a year later, the market is up more. Obviously, 3 and 5 years, the market's up substantially more. So the reason I think this chart is important to look at is that the market starts to move before the recession ever ends. In fact, typically 3 months before the recession ends. I hope we're not in a recession. I don't want anyone to lose their jobs. I don't want anybody to lose their house. But if the people that are predicting that we're in a recession already are right, means the market's fixing to turn. If we're not in a recession and the Fed can pull off a soft landing, which is still even odds chance they're going to be able to do that, then that's even better. You'll notice on the chart there's only one exception where from the end of the recession, a year later from the end of the recession, the market was down, and that was 2001. The obvious reason for that was September 11th, 2001. But every other bear market that we've been in, that led to a recession, and we're still not there yet. We don't know if this one leads to a recession or not. As I've said earlier, like I said, Paul Samuelson said that the market's predicted 9 out of the last 5 recessions. In other words, it's not always right. But the only time that the market hasn't done substantially well, 3 months, 6 months, a year later, is 2001 when we had 9/11. But obviously, 5 years later, the market was still up substantially from that point in time. So my message today remains the same, and that is you can't sell the market. It's this type of a market. It's no fun to be down, but you have to be an investor. you have to go back to what Paul Samuelson said, and that is investing should be like watching paint dry or watching grass grow. It takes a a longer period of time. And in the longer the period of time that you look at, the better the market does. You know, when you watch the financial news channels and you hear the gloom and doom on the television, it's, I think, important for me to point out that most of what they're referring to is very short-term predictions and thought processes. If you ask any of those market pundits what they thought the market would do a year or 2 or 3 years from now, they'd all say it'd be much higher. So keep in mind that they're looking at the market on daily, what's it doing today, tomorrow, what might it do next week. You look 6 months, a year down the road, and the market has always been actually the best asset class during a time of inflation and rising interest rates, or the best hedge against inflation. You know, they're also talking about removing the tariffs on China. If they do that, that will immediately mitigate cost, especially for low-end retailers where they're not able to pass along costs to the consumer. That will reduce their costs, increase their margins, and that will help as well. You know, the market's perception changes pretty quickly. And when it changes, you have to be there. Otherwise, it's a much tougher decision to get back in the market if one succumbs to the emotional trauma that we've been through the last 6 months. You know, I said a minute ago, and I didn't finish my thought, when it's the worst 6 months to the beginning of a market since 1970, why would anybody get out? The fact is, the market always recovers. In fact, it's recovered, ready, 100% of the time. So you just have to be an investor and not a trader, and know that all will be fine. We are in a extremely pessimistic period of time. That's when the next raging bull market typically starts historically, and time will be on your side. With that, I hope this has been helpful. Thank you, everyone, and let's look forward to a great second half of the year. And one other comment I wanted to make. In the last little quip I put out, I said, is it October yet? A reminder that in the fiscal year starting October, in the third year of a presidential cycle, the market has historically averaged 19.8%. No other fiscal year in the other 3 years of a presidential cycle has the market done double digits. One of the reasons for that is we have the midterm elections coming up. It's expected that Republicans will at least take the House back, which means you'll have the executive branch with the Democrat Party and the legislative branch controlled by the Republican Party. Whichever it is, even if it was reversed, the stock market likes gridlock. It's like, well, they can't do anything to us too bad when there's gridlock in Washington, D.C. That also has proven to be one of the best times for stocks. The 6 months after midterm elections has done significantly better than the 6 months prior to midterm elections historically. So hold on to your hat. We're still going to be volatile for a while, but if you can look past the current volatility, watch the grass grow, watch the paint dry, give it some time, we are very confident that you'll be rewarded in time. Thanks, everyone. Enjoy the summer.